Good morning. I'm David Reese, the newly appointed RGB Chair, and I'd like to welcome you to this public meeting of the New York City Rent Guidelines Board. This is the first meeting in a series of public meetings and hearings to determine renewal lease adjustments for rent-stabilized housing units in New York City, with leases commencing or being renewed on or after October 1st, 2019, and on or before September 30th, 2020. I would like to take this opportunity to welcome three new additions to the board: public members May Yu, Alex Schwartz, and Herman Tejeda. Both Ms. Yu and Mr. Schwartz are with us today, but due to a prior commitment before his appointment, Mr. Tejeda is out of the country and could not be here today. I look forward to working with them all. I will now take roll call. Please respond if present. Shayla Garcia.
Present.
Leah Goodridge.
Present.
Cecilia Hosa.
Present.
Alex Schwartz.
Present.
Herman Tejeda. Scott Walsh.
Present.
May Yu.
Present.
David Reese, present. With the arrival of new members, I would be remiss if I did not recognize the contributions of the four members who have left our board: Kathleen Roberts, Hilary Botine, Rodrigo Camarena, and Angela Pinsky. I would like to recognize their hard work and dedication to the RGB, so on behalf of the current members, I would like to thank them and wish them well. City Hall is in the process of filling the owner vacancy, and we hope to have a new member in our near future. In your folder, you will find copies of the 2019 Income and Expense Study and the 2019 Income and Affordability Study, which will be presented at today's meeting. After the presentation of the RGB reports, we have a guest speaker from Housing Preservation and Development, Assistant Commissioner for Housing Policy, Lucy Jaffe. Our next meeting will be here at the Landmarks Preservation Commission Conference Room on April 18th, starting at 9:30 a.m. There are copies of the most current 2019 meeting schedule in your folders, and it can also be found on our website, nyc.gov/RGB. Copies of our schedule are here today. The preliminary vote for rent-stabilized renewal lease adjustments is currently scheduled for May 1st at the Great Hall, Cooper Union, 7 East 7th Street in Manhattan, starting at 7 p.m. The final vote is scheduled for June 25th at the same location and time. Please note that the public hearings are being finalized and will be released to the public within the next few weeks. If you are interested in receiving email updates about upcoming RGB meetings and hearings, please take one of our flyers that are here today. Or you could sign up by going to the board's new homepage at nyc.gov/RGB. Please note that the annual filing of the Conflicts of Interest Board Financial Disclosure Report filing period will run from April 8th through May 3rd. Individual packets for board members are here today. If you haven't already done so, please see Charmaine before you leave so that you can sign for and receive your packets. She will also distribute a memo from COIB regarding tips for filing. Also in your folder, you will find non-public per diem forms. Any questions, please see Andrew. I will now introduce Brian Hoberman, RGB's Research Director, to present the 2019 Income and Expense Study. Please note that there are copies of this report here today and will be made available on our website after the meeting.
Good morning.
Good morning.
Welcome to the returning board members and to the new board members. It'll just take a second for the projector to warm up and I'll get started. Okay, thanks for your patience. The 2019 Income and Expense Study analyzes data from real property income and expense filings. These forms were submitted to the Department of Finance in 2018 and reflect conditions during 2017. We also compared this data with filings from the prior year. Before I go into detail, a summary of our major findings. On average, in stabilized buildings between 2016 and 2017, both rental income and total income increased by 3%, operating costs increased by 4.5%, and net operating income, NOI, grew by 0.4%. I will now go in to discuss the findings of this study in more detail. First, let me briefly review the methodology used in the study. Local Law 63 was enacted in 1986 and requires building owners to file RPI forms with the Department of Finance annually, with some exceptions. Those exceptions include condos and other types of buildings, residential buildings with fewer than 11 units that have an assessed value of under $40,000. The Department of Finance matched 2018 RPIE filings with the New York State Homes and Community Renewal building registrations in order to get the sample that was used for this report. Then the data was screened for errors and those records were removed. There were two data sets created. The main RPIE analysis of 15,395 buildings that contained 694,485 units. This data is used to compute average revenues and costs for a moment in time view. And we also did a longitudinal analysis of 14,332 buildings that contained 652,978 units. The longitudinal analysis encompasses 2 years' worth of RPIE filings. In 2017, rent-stabilized property owners collected monthly rent averaging $1,353 per unit. Similar to prior years, units in pre-war buildings rented for less on average, $1,273 a month, than those in post-war buildings, $1,534 a month. At the borough level, the average monthly rent in stabilized buildings was $1,850 in Manhattan, with a breakdown of $2,247 in core Manhattan, which is the area of Manhattan south of West 110th Streets and East 96th Streets, and $1,343 in Upper Manhattan, which is the remainder of the borough. It was $1,301 in Queens, $1,224 in Brooklyn, $1,046 in Staten Island, $1,006 in the Bronx, and the average monthly rent per unit in the city, excluding core Manhattan, was $1,204. Looking at the median monthly rent citywide, it was $1,208. Many stabilized buildings supplement their rental income by selling services to tenants that include laundries and parking fees, and they also earn commercial income from things such as retail and cell phone towers. In 2017, rent-stabilized building owners in New York City earned on average $1,524 per unit, with pre-war buildings earning $1,440 and those in post-war properties earning $1,716. By borough, Manhattan income was the highest, with an average income of $2,217. The average was $2,729 in core Manhattan and $1,562 in Upper Manhattan. In the remainder of the city, Queens averaged $1,385, Brooklyn's average was $1,301, Staten Island averaged $1,141, and the Bronx saw average income of $1,122. In the city, excluding core Manhattan, the average income was $1,299. And looking at median monthly income, the citywide median was $1,309. This graph, which is also in the report, shows that average monthly income and rent were the highest in core Manhattan and lowest in the Bronx. Core and Upper Manhattan are both shown at top, and the city without core Manhattan is shown at the bottom. Average income is in maroon and average rent in gold. The sale of services and commercial income account for 11.2% of the total income earned by rent-stabilized building owners in 27 citywide. That was down half a percentage point from the previous year. By borough, income earned from services and commercial rents was 16.5% in Manhattan, 17.7% in core Manhattan, and 14.1% in Upper Manhattan, 10.4% in the Bronx, 8.3% in Staten Island, and 6% in both Brooklyn and Queens. There are two independent data sources, the Triennial New York City Housing and Vacancy Survey, the HVS, and New York State Homes and Community Renewal, HCR, annual registration data, and they provide important comparative rent data to the collected rents stated in the Department of Finance RPIE filings. A comparison of the collected RPIE rents to both the HVS and HCR rents is an indicator of the overall rental market and reflects both how well owners are able to collect the rent roll and the prevalence of vacancies. HVS data consists of contract rent, which is the amount stated on leases, including both legal and preferential rents. And HCR data consists of legal rents registered annually with the agency. The latest RPIE and HVS data from 2017 shows that the HVS average contract rent of $1,269 for all rent-stabilized apartments was 6.2% less than the RPIE average collected rent of $1,353 among buildings containing rent-stabilized units. In comparing RPIE and HCR average rents, the gap between the two in 2017 was 27.9%, as indicated by the average IE rent of $1,353 and HCR's average legal stabilized rent of $1,876. This graph shows the comparison between RPIE rents and rents registered with HCR since 1990. HCR rents are legal rents, or in other words, the maximum amount that can be charged in rent-stabilized apartments. While we know that because of vacancy and collection losses and market forces, it causes owners to charge lower preferential rents, owners never collect on average 100% of what can legally be charged. This graph shows that on average, owners collected 72.1% of HCR rents, or the maximum allowed in 2017. That's down from 75.9% in the prior year. The gap grew 3.8 percentage points from the prior year, which indicates that building owners are collecting a smaller proportion of the maximum legal rent in 2017. Next, I'll move on to expenses. The average monthly operating cost for units in stabilized buildings was $984 in 2017. Costs were lower in pre-war structures, averaging $944, and higher among post-war buildings, $1,075. By borough, the average costs were highest in Manhattan at $1,397, followed by Queens at $892, Brooklyn $837, and Staten Island $768. The lowest was in the Bronx at $763. Within Manhattan, costs were higher in core Manhattan, averaging $1,678, and the costs were $1,037 in upper Manhattan. If you exclude core Manhattan, the average monthly operating cost was $846 per unit. In 1992, the Department of Finance auto-adjusted expenses reported by building owners on RPIE forms and found that the costs were overstated by roughly 8% on average. Adjusting the costs in 2017, RPI data by about that 8% results in an average citywide cost of $904 per unit. Operating expenses in buildings without commercial space are generally lower than buildings with commercial space. The figures noted on the slides up to this point include expenses for buildings with commercial space. However, we can also look at buildings without commercial space, and we found that the average monthly audit-adjusted cost was $820 per unit citywide. Meanwhile, looking at median costs among all rent-stabilized buildings, which are not audit-adjusted, citywide, the 2017 median expenses were $870. By borough, Manhattan had the highest median costs at $1,182, $1,350 in core Manhattan, and $929 in upper Manhattan. In the other boroughs, Queens was at $825, Brooklyn at $778, Staten Island $738, and the Bronx at $737. Median monthly expenses in the city, excluding core Manhattan, was $795. This graph breaks down expenses by component and further splits them into pre- and post-war categories. The largest share of expenses went towards taxes, followed by maintenance and administrative costs. Post-war buildings, indicated in this graph in maroon, spent more on taxes, administration, labor, maintenance, and miscellaneous costs. Pre-war buildings, shown in blue, spent more on fuel and insurance, and both type of buildings spent about the same on utilities. The average expense per month for all stabilized buildings is shown in gold. In 2017, 5% of buildings were found to have operating and maintenance costs greater than gross income, which are considered distressed. That represents a 1/10 of a point increase from the prior year's 4.9%, which was the lowest level ever recorded in this study's 28 years. The vast majority of distressed buildings are pre-war, 93%. By borough, slightly more than half the distressed buildings are in Manhattan, 51%.
Brian, could I ask a question? Do we track distressed buildings over time to see whether it's the same buildings that are distressed, or?
We're not able to do that. We could ask finance, but we generally don't get that information. We get the longitudinal, which looks at 2 years, but
I'm sorry, the longitudinal.
the longitudinal, we only look at 2 years, so.
2 years of whether it's the same building or not.
No.
Oh.
2 years, when I discuss the longitudinal sample, I don't discuss distressed buildings specifically because we don't know if it's the same buildings. They may not file in both years, so it's a little tough to track.
Okay, thank you.
I mentioned 20% are in the Bronx, another 20% are in Brooklyn, 8% are in Queens, and less than 1% on Staten Island. Since 1990, when 13.9% of stabilized properties were considered distressed, the proportion of distressed buildings has declined each year through 1999, reaching a previous low of 6.1%. From 99 to 2004, the proportion generally increased. However, since 2004, the proportion of distressed properties fell in most years to last year's record low of 4.9%, but increased slightly this year to 5%. There is no direct way to measure profit in the rent-stabilized buildings in this study. We would need to know a great deal of individual building information such as debt service, mortgage interest rates, etc., and that is not available. We have instead 2 surrogate measures for profit: net operating income and cost to rent and income ratios. We'll look at net operating income first. The amount of income remaining after expenses are paid that is used for financing buildings, making improvements, and pre-income tax profits is referred to as NOI. NOI is considered a good indicator of a building's financial health. In 2017, rent-stabilized apartments averaged $540 of net income per unit per month, while units in post-war buildings on average earned more, $641, and units in pre-war buildings earned less, $496. Average NOI per unit in residential-only buildings was $482, 10.8% less than the average for all rent-stabilized buildings. In 2017, average NOI was significantly different by borough. Manhattan had the highest NOI at $820, with core Manhattan units having significantly higher NOI at $1,051 than upper Manhattan units, which on average earned half as much, $525 per month. In the other boroughs, NOI in Queens was $493, followed by Brooklyn at $464, Staten Island at $373, and the Bronx at $359. If you look at New York City, excluding core Manhattan, the average monthly NOI was $453 per month. The second surrogate measure for profit is the cost to rent and cost to income ratios, which reveal how well the rent-stabilized stock is doing. Cost to income ratios can be used as a tool to evaluate a building's financial health, making the assumption that buildings are better off by spending a lower percentage of revenue on expenses. In this graph, the audit-adjusted cost-to-income ratio is shown in maroon, the bottom line. In 2017, operating costs were 59.3% of gross income, 1 percentage point higher than the prior year. That means that owners on average spent on costs a little more than 59 cents of each dollar of revenue that they earned. The cost-to-rent ratio, which is the upper line, has followed a similar trajectory, rising 0.8 of a percentage point this year to 66.8%. This slide breaks out rent, income, cost, and NOI figures between core Manhattan, which is on the left, and the city without the core, which is on the right. The graph shows that average rent, income, costs, and NOI are a great deal higher in core Manhattan compared to the rest of the city. When looking at the cost-to-income ratios, the difference between the two demonstrates that core Manhattan owners spend, on average, compared to owners in the rest of the city, about 3.3 cents less of every dollar earned. In our study, we also report the ratios that use expense figures not adjusted by the audit. Looking at unaudited expenses, the cost-to-income ratio in 2017 was 64.6%, representing a 1.2 percentage point increase from the prior year. And the unaudited cost-to-rent ratio was 72.7%, a 0.9 percentage point increase from the prior year. In an analysis of the distribution of operating costs in relation to total income in buildings by decile, it may be useful to examine the percentage of buildings with cost-to-income ratios at or below certain levels. The Department of Finance calculated decile levels for us, and in examining them, for instance, decile statistics reveal that half of all rent-stabilized buildings citywide have unaudited cost-to-income ratios of 0.64 or less. This means that half the building owners spent no more than 64 cents out of every dollar of revenue on operating and maintenance costs in 2017. To look at another decile level, the 70% decile level citywide, which means that 7 out of 10 building owners pay no more than 73 cents of every dollar of revenue on operating and maintenance costs, and the remaining 3 of 10 pay more.
Brian, can you just break down the fact that this is unaudited? What should our takeaway be, the fact that it's unaudited?
It just means that it's not adjusted for the audit that was done back in 1992. These are the actual numbers, not adjusted in any way.
And the previous slides were we always looking at unaudited, or?
We do mention if it's audited or unaudited usually on the slides.
What's the rough difference between audited versus non-audited?
It's about 8%.
8%, okay.
But from 1992.
Right.
We haven't been able to,
Discussed this with Department of Finance last year.
yeah, we haven't been able to determine if that's changed at all, and I think it's very expensive for them to do a new audit. So, now this graph is useful because it shows the change in income, rents, expenses, and NOI citywide over 28 years since we've had comprehensive data, and it takes inflation into account. During this period, income, which is shown in blue in the top line, was up an inflation-adjusted 39.4%. Rent, the second line from the top and in gold, was up 38.5%. Costs, the third line from the top and in maroon, were up 32.9%. And net operating income, represented by the bottom line, increased by 53.1% citywide. And note that this is an inflation-adjusted point-to-point comparison where the changes are shown over the period from 1990 to 2017, the most recent year we have data for. These graphs represent the same time period as the graph on the last slide, but it breaks it down by borough. And like all the other graphs, this is in the report if you're having trouble reading it on the screen. Now, these graphs show that while the actual inflation-adjusted income, rent, costs, and NOI figures are far higher in Manhattan, the percentage increase in NOI was not the highest in that borough. Brooklyn, at the top right, saw the largest NOI increase over this period, with NOI more than doubling, rising 106%. Queens, at the bottom left, had the second highest NOI increase, rising 74%. The Bronx, at the bottom right, experienced NOI growth of 71%. And finally, in Manhattan, at the top left, saw NOI grow 48% over this period. Now we'll move on to the second part of the income and expense study, which is the longitudinal analysis. The longitudinal sample encompasses properties that filed RPI forms reflecting conditions in 2016 and 2017. By conducting the longitudinal analysis, we can more accurately track changes from year to year as the same buildings are being analyzed. The average rent collections in stabilized buildings rose 3% in 2017. Rent collections in pre-war buildings grew 3.2%, greater than in post-war buildings, which increased by 2.8%. Rent collections increased the most among the smallest 11 to 19 unit buildings, up 3.5%. Mid-sized 20 to 99 unit buildings rose 3.2%, while rents grew 2.3% among the largest 100 plus unit buildings. Average rent grew in every borough. Brooklyn saw the largest increase, up 4.1%, followed by Queens, up 3.4%, Staten Island, up 3.3%, the Bronx, up 3%, and Manhattan, up 2.3%. Within Manhattan, Upper Manhattan rents grew at a faster rate, up 3.5%, than the 1.7% increase in rents in core Manhattan. If you look at the city excluding core Manhattan, rents rose 3.5%, and looking at the median rent citywide, it was up 3.3%. We can also examine rent collections throughout New York City in community districts. Every community district saw increases in average rent.
Brian, just to be clear, when we're talking about average rent, we're talking about the entire rental stock.
We're talking about the rent-stabilized buildings that are...
Okay, including the non-stabilized units in those buildings.
Right, we measure it based on the Department of Finance measures it based on the building. There's no way to differentiate between stabilized units and non-stabilized units because the costs are merged through the building. At the local level, the greatest rent growth was found in the Rockaways in Queens, seeing rents rise by 7%, followed by Central Harlem and Manhattan, rising 6%. Comparatively, higher rent increases were also seen in several Brooklyn neighborhoods, including Park Slope, Carroll Gardens, up 5.8%, Bed-Stuy, Brooklyn, up 5.6%, Brownsville, Ocean Hill, Brooklyn, up 5.4%, and East New York, Starrett City, up 5.1%. The neighborhood in the Bronx, seeing the highest growth in rents, was Riverdale, Kingsbridge, up 4.1%. A list of all the community districts and how much their rent changed can be found in Appendix 13. The average total income collected in rent-stabilized buildings, comprising apartment rents, commercial rents, and sale of services, grew by the same percentage as rent, up 3% from 2016 to 2017. Revenues grew faster in pre-war buildings, up 3.2%, compared to 2.8% among post-war buildings. Brooklyn saw the highest growth in income, rising 4.1%, followed by Queens, up 3.4%, the Bronx up 3.1%, Staten Island up 2.9%, and Manhattan up 2.4%. Within Manhattan, Upper Manhattan income rose 3.5%, while core Manhattan income grew by 1.9%, and total income in the city, excluding the core Manhattan, grew by 3.5%, and median growth in income citywide was 4%. Average expenses in stabilized buildings citywide rose by 4.5%. Both pre-war and post-war buildings rose by the same amount. However, the change in operating costs varied by borough. Costs grew the most in Manhattan, up 5.1%, followed by 4.8% in Brooklyn, 4.7% in Queens, 3.6% on Staten Island, and 3.2% in the Bronx. Within Manhattan, core Manhattan costs rose by 5.2%, while Upper Manhattan costs grew by 4.8%. Operating costs in the city, excluding the core, grew by 4.3%, as did median citywide expenses. Everything is unaudited in the longitudinal part of it that we're reporting, actual percentage changes. It could be useful to compare the cost changes calculated from RPIE data from the price and cost data from the RGB's price index of operating costs, which for this report was adjusted to match time periods between the two. The adjusted PIOC is in maroon and the RPIE data is in gold. As the graph shows, the income and expense data grew at different rates than the price index in some years since 1990. In the most recent year, the adjusted PIOC grew by 5%, the same period as the 4.5% increase in the income and expense costs, a half a percentage point difference. Between 2016 and 2017, the proportion of gross income spent on audit adjusted expenses, here it's audit adjusted, the O&M cost to income ratio rose 0.8 of a percentage point. The proportion of rental income used for audit adjusted expenses, the O&M cost to rent ratio, also rose, increasing by 1 percentage point. Net operating income per unit on average in rent stabilized buildings increased by just 0.4% in 2017, the smallest increase over the 13 consecutive years that NOI has grown. Citywide, NOI in pre-war buildings increased 0.6%, while newer post-war buildings grew by 0.1%. The average change in NOI differed throughout the city. NOI increased in each borough except Manhattan. NOI grew the most in the Bronx, rising 2.9%, while it rose 2.7% in Brooklyn, 1.5% on Staten Island, and 1.3% in Queens. However, in Manhattan, NOI declined 2%, though the decline occurred solely in core Manhattan, falling 3.1%, while NOI rose at 1% in upper Manhattan. The monthly NOI in the city, excluding core Manhattan, rose 2.1%. At the community district level, NOI increased in two-thirds of the city's districts. The neighborhoods seeing the greatest growth in NOI were Central Harlem in Manhattan, up 18.4%, the Rockaways in Queens, up 16.8%, Bed-Stuy, Brooklyn, up 15.6%, and Mott Haven, Port Morris in the Bronx, up 10.7%. Meanwhile, of the one-third of neighborhoods seeing NOI decline, the largest decline was on the Upper West Side of Manhattan, declining 5.7%. Throgs Neck Co-op City in the Bronx was down 4.8%. Stuytown, Turtle Bay fell 4.6%, and Forest Hills, Rego Park in Queens fell 3.9%. The largest decline in a Brooklyn neighborhood was in Bensonhurst, falling 2.2%, and the list of all community districts and how much NOI changed can be found in Appendix 13.
Question about NOI. This includes total income, right? Not just rent.
NOI is the difference between total income and expenses.
And so all the vacancies and storefronts in Manhattan probably contributes to the drop in.
It's all included. As long as the building is rent stabilized, it would be included. Yeah, basically, and yeah. This table lists the average annual change in rent, income, expenses, and NOI from 1990 to the present, and it's also reproduced in the report, if you're having trouble reading it. Yes?
Can you explain a bit more, since NOI is after expenses are taken out? I know earlier what was mentioned is that there are no profits in the studies, but can you explain a bit more how we can gauge how much landlords are actually making? If it's not profits, then how do we reconcile that it's still after expenses are taken out?
Well, we mentioned profits because there are some other categories we can't include in the study, or don't include in the study, like major capital improvements, mortgage expenses, and whatnot. So the only thing we can measure are the actual expenses paid based on the filings with the Department of Finance. So we're just taking it, the NOI is just the difference between those expenses and the income collected as reported in the filings with the Department of Finance. So you can look at it as one measure of how well a building owner is doing. But in terms of knowing exactly what the final total is after some other expenses are included, we can't determine that.
I mean, I think it's directional, but not precise. It's definitely not precise. But is it, just to recall from prior years, is it true that like all of the city expenses, for the sustainability studies and all of the city mandated things, do they go into the expenses or they're excluded from the expenses?
I mean, there are the 9 major categories. If you look at the RPIE, it includes pretty much everything except for the few categories I mentioned, like major capital improvements, debt service. So I would think those other ones are included in management and maintenance.
I just feel like
miscellaneous.
when Sarah was on the board, we explored this and we found that they weren't included. I'd just like to get clarification on that.
Yeah. Our understanding they are included in the INE. It's the PIOC that they're not necessarily included. Yeah, and that may be what you're thinking. But if it's an expense, the owner can certainly put that expense down, and it should be a part of what they're reporting to finance.
But we do see both the expense and the income in the finance records, right?
Yeah, we have expense.
Eventually we'll see them, regardless of whether the expense happened the first 2 years of NMCI, and then you start collecting rent 2 years, the increase 2 years later, you also will see when they actually file that expense at some point.
In terms of an MCI, the increase that was given for rent will show up on the income side or the rent side. And when the expense is initially laid out, if it's an MCI, recapturing that expense, if it's not an operating and maintenance cost, the expense would not necessarily be captured in that.
So that overstates, just to be clear, so that overstates income over expense in the case of an MCI.
In the case of an MCI, yes, because major capital improvement expenses are not included as something that's required, as an expense. I mean, I could clarify that, but that's my understanding, is they don't include those as,
I mean,
not
I would,
allowed to include
I would
that on there.
actually like that clarity, because if a landlord fixes the roof, I don't know why that wouldn't be captured as an expense at some point.
Well, fixing a roof would be captured.
Right.
Putting a whole brand-new roof on would not necessarily be captured. There's certain expense, if you get a plumber to come and fix an individual apartment because of a leak, that's definitely captured. That's an operating and maintenance expense. But if they do renovation to a unit, request of the tenant, or if they do a building-wide, they put in new windows for the entire building, that's a major capital improvement.
Yeah,
Well,
the
yeah.
MCI is getting depreciated, right? So it's being handled on their balance sheet.
Yeah.
It's a different item because it gets handled differently for taxes. So they're not encouraged to
Put it in.
throw in that because they want to be able to get the tax to depreciate the major capital improvement.
And in theory, would increase property value that's, right, yeah.
Would increase taxes, so.
So, to clarify for, with the NOI figures and increases that we're seeing, expenses do not include capital improvements and debt service. Are there any other categories?
Those are the major ones. Let me see. I think we mentioned it here.
It wouldn't also include, any taxes they have to spend, pay on their profits, so any income
Right.
tax. So that's not included as well, so
Right.
that wouldn't necessarily be included.
Right, financing costs, income taxes, and appreciation determine the ultimate value of a property, so those are excluded.
Okay.
That's in the net operating income section, the first paragraph, page 9. That's where we discuss basically the caveat of using an NOI, but we consider it a good indicator, especially tracking it from year to year.
Yeah, I think that's the key with NOI, is tracking it over time. Or any
Right.
of these things that we're doing, rent, expense, it's tracking it.
Right, so this summarizes the period of time since we have been collecting this data, going back to 1990, but the bottom row shows the summary from this year's study, shows the citywide average rent and revenue collection, each rose 3%, expenses rose 4.5%, and despite the greater rate of increases in expenses, NOI citywide increased by 0.4%. This was the 13th consecutive year that NOI rose, but it was also the smallest increase over this period. Any more questions? I will be
I
happy to
just
take
have
them.
one question on this. Do we have any way to get data on, obviously, if it's 3%, there would potentially be some buildings that are negative and some buildings that are zero, and some, it's an average. Do we have a way to understand, if 3 is the average, there may be some people who are, far exceeding the average because they have parking and various other sources of income, but other people who may not have any other source of income and be 100% rent stabilized, are they well under the 3% threshold?
Well, we do take a look at residential-only buildings, so that's going to take the commercial, so we do report on some of that.
Do we report on it, though, in this measure? So we take, for residential-only buildings by borough, what was the average rent growth, over this year?
Yeah, we
don't, well, in the longitudinal section, we don't really discuss
We don't do it in the
residential.
longitudinal, we report that in, the cross-sectional, but I
Could we
don't know
do,
why we couldn't do it in the longitudinal.
It might be available. We'll see what we have from finance.
could we, along the lines of what Scott says, can we do it by decile? Can we say, is that possible?
That would be an additional request.
That would have to be, decile would have to be an additional request. For the new members, we don't have this data set. RPIE data is, there's privacy issues with it, so anything that we need to run, we have to ask finance to run, so we don't have the entire data set. So when we say we can or can, it depends on whether what they've given us is, we can answer the question or not. We will have data. Last year, we did a memo, and we're updating it again. We take a look at units with 20%, 80%, no, 20%, 50%, 80% stabilized units, and we'll look at those, and we will have a longitudinal look at that as well. So that will capture, I think, what we're talking about, the buildings that are really rent stabilized. So there's a group with 80% or more units that are stabilized. Those will include in commercial rent, but I think it will be, last year we found there was very little difference from those groups as the total citywide group. But we're going to take a look at it again this year. We just got the last bit of data beginning of this week, so we didn't have time to turn it around, but we will redo that memo.
Yeah.
And see if it looks the same or it was similar to what happened last year. So that will.
And this is just a question for you, David. Is there a way in some of these data sets where we could just get a separate memo and just overlay what was the rent increase, because this is all rear view mirror, what was the rent increase the board approved on the 1 and the 2, and we know the blending of what the uptake is, just to be able to say, okay, on that year, of all the people who renewed, it averaged 2%, so clearly if this is higher, we kind of have a sense of where the increase directionally moves things.
I'm not sure if I understand, so could you just explain it again?
So I'm just saying,
Scott.
for calendar year 20, for whatever year we're talking about, so if we're saying 20, this is change from 16 to 17, right?
Right,
But
those
in-
last years were rent-free years.
They were rent-free years, but they did have increases on the 2-year lease, so, right? So,
Scott.
and we know how many 2 years
If you look
got
at
taken.
page 7, we have a rent comparisons table
Yeah.
here that actually basically tracks what you are looking for because it includes the RGB rent index
Okay.
in the third column, and that shows the guidelines.
But so just so I understand it, this column, from a definition standpoint, it's taking into effect the number of people in the city who took 2-year leases versus 1-year lease.
I believe it does, right,
And
Andrew?
it's fixing the calendar year problem, because obviously increases go into effect September 30th. and
Adjusted.
This
These
is
are
adjusted for the
as well
time
as
problem, okay.
Yeah.
Right, but it takes in 1 and 2-year lease and actually vacancy leases too.
Okay.
That rent index does all those things. So that was the purpose of that table, is to track what the board, essentially the impact of increases in rent
Right.
by what the board does versus what the I&E is showing and what the HVS is showing.
Okay, got it.
So for example, it shows, in the most recent year, it shows that the rent index, the RGB rent index was 2%, but the RPI rent growth was 3%. So it was 1 percentage point greater. And the HCR rent growth was even more than the RPI rent growth, and that reflects legal rents, yeah.
Yeah, I'm sorry, I said HVS, not
I
HCR.
have a question. So on page 17, under average cost growth, it's 4.5 for the last year, and that seems on the higher end when you compare like the other years. Do you have insight or some sense as to why the cost grew so much over a period of like just 2 years?
Compared to previous 2 years, I don't know why exactly. I think probably the price index, I guess you measure more of the changes in the components. Andrew, I don't know if you have any idea.
Yeah, we're going to present the price index at the next meeting. But there's certain things, taxes always impact growth. Real estate taxes is the biggest expense, and they're going up. They go up every year, based mostly on assessments. What we're finding, though, I think that is labor is starting to go up as well, because I think the non-union labor sector is making more money because of the minimum wage. So that's more expense for owners. Fuel is always an issue. So I believe last year was up, this year it's up again. So there's different factors that are going into it, but a lot of it is driven by labor, and some of that will reflect not just the labor costs that for people, owners who, that for the janitors and supers and whatnot, but it also the people they hire, the contractors. We're finding that that's the case. So in a nutshell, I think it really taxes and labor and fuel in recent years.
So based on that, though, we would expect Because the 15 didn't go into effect until January 1st, right? So we would see, this trend will continue more into the future probably than less.
Yeah, certainly the labor portion of it, yeah, because it's continuing to rise.
Andrew, just on Scott's initial point about the deciles, if we could do that, I think that'd be useful, because if we want to identify whether, there's a canary in the coal mine of any, so I think looking at 80%, 50%, 20% rent stabilized is one good metric, but there might be other buildings that don't match that. If we could look at it by decile, it might tell us if there's, if the average is close to zero, are there people really way below that?
Right, so we have a decile for everything right now, that we have that already. So you're asking for decile by just residential only? Right now we
Decile
have
by NOI.
Just more average rent growth, just to see how that, if there's people who are way out of the range, or if the range is super tight. We just don't have any sense of what the range is. If we knew the range was like 3.5 to 2.5, then we'd say, okay, 3% makes sense. But if the range is 7% to -2, then there's a little bit more inquiry as to where people stack up. And there are tons of people who are really at 5, and then tons of people who are at 0. I don't know.
Yeah, I'm not sure we can get to that. I'm not sure. We'll have to see. Because ultimately, we do NOI with the data that we get from finance. So I'm not sure if finance could run those deciles unless they determine what NOI is. Right, Brian?
They don't calculate NOI.
They
We would
don't
have to have,
calculate
I
NOI.
mean, we have, if you look at the deciles that we already have in the appendix on page 25, I mean, that breaks it down into deciles for each of the 5 boroughs, so you can get an idea. I mean, that's basically,
that's the cost
looking
per
at
dollar.
the cost-income ratio and NOI is essentially, they run in tandem with each other, so this gives you the same idea that the range of NOI would be.
Wait, so Brian, just break it down. So this is table 8. So this is operating cost to income ratio by decile. So why is that not exactly what is that what Scott is asking for, or is that something different?
This is based on cost to income. So we're taking, for example, if you take a look at the 50th percentile.
Cost to income. Yeah.
Right, so 64 cents on the dollar is going toward O&M. Half of the people are paying 64 cents or less, right? Half the owners. If you jump up citywide to 80%, the 80% of the owners are paying 79 cents.
Or less.
Or less. So where you feel like whether it's a 70 percentile, you get into an area where distress, we determine it, expense exceeds income, but that doesn't mean that an owner, at 90% is running a healthy, healthy building, if that's what you're trying to get at, right?
But if we had an estimate of what debt service was for the average building, and let's say debt service was
Debt
15
service we can't get.
No, I'm just saying, but if I estimate, and I'm not saying this is an accurate estimate, but if I estimated that debt service for an average building was 15% of your income, then I would say, well, if you have a 0.89, in the 90th percentile, if your operating cost to income ratio is 89, then I would say, oh, this building is operating at a loss.
We already know about distressed properties. We don't know what the debt service is, but we can track the change in distressed properties like we
So
do.
we know
Going back to
5%
1990.
is- yeah.
So we know that at this point, it went up by 0.1% from last year, but compared to years in the 1990s and 2000s, it's a great deal lower. So we can measure it, the change from year to year, but we don't know what the debt service is, so
Right,
we
right,
just sort of
right.
have to leave that as an unknown.
I got
What
it.
we know is here.
I mean, I think the other thing, when we had the finance department testify, was it last year or a couple of years ago, one of the things that I was really struck by was just how accurate some of the reported data is and how they actually have to themselves adjust some of this because it's so, all over. And so I just wonder, what picture does this paint in comparison to how accurate some of that data they're actually collecting and giving to us is. So I would I don't know if you have clarity on some of any of that,
I mean,
but yeah.
we've had Department of Finance testify about how accurate it is, and they seem confident in it, so we're as confident in it as they are, I think.
That's the best answer. But there is adjustment. They recognize that if they look at a building, and they do it at both ends, if expenses are exceeding what the norm is for that particular area, I don't know if they do it by zip code or community district, but they'll take, and readjust their assessment based on the over expense. Same thing on the other end, if they feel like they're under, reporting expense, they actually increase their expense portion of it, so which would actually impact of lowering their assessment.
We get the data after they've done that exercise.
No,
We get it before that.
before that exercise, because they do that, the RPIA data is then, they take that and do all their assessments. So they go throughout the, in a walk-up building and blah, 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 in the, West Village, and, with X number of units, pre-war is gonna be assessed a certain way. And they will throw in different factors depending on what's going on with that. So we get it, the raw data before that. So we understand there's some limitation, some over-reporting that's going on. We understand that. I think over time they've made the RPIO form much more specific of what they can report, particularly in miscellaneous. So I think owners are certainly more clear about what they can report, which hopefully leads to accuracy, and I think they feel that that's happened. But they recognize they're still over-reporting to some degree, because they make those adjustments. They understand that. But I think the form itself has certainly clarified what an expense is.
Question, Brian, so I was wondering if you could explain a little bit more what you mean. I'm going to read a sentence. Rent collections increased the greatest among smaller 11 to 19 unit buildings. This is on page 13. And above that, it talks about rent collections being, through renewal, vacancy. But
What is included?
We talked about, last year, we talked a lot about smaller buildings and their ability to increase rents and get income. So I was wondering if you could talk a little bit more about that.
This is just what we're reporting, what we're getting from finance. I'm not sure what you're asking exactly.
Well, so for one, when it says that the increases or the collections are greatest among the smaller buildings.
Right, among the three categories of building sizes that we have. That's what I mean, the greatest among that category.
So specifically that the owners are able to collect more, greater increases?
Basically, the
or-
percentage increase in rent from one year to the next is higher among 11 to 19 unit buildings.
So smaller buildings had a larger increase, and we don't like to use profit, but
This is just rent.
appearance of being able to collect more rent.
It's just a measure of how much the rent went up. It's not income.
Yeah, it's rent revenue, right? It's not.
Yes, it's not income in this case. We do report income as well later on, and it probably is similar. Yeah, revenues increased more. I'm sorry. I don't
it's
think I
just,
talk about
we-
building size there, but
Yeah, so there was, I recall last year we were talking about smaller buildings and their ability to do well in comparison to larger buildings, so I thought that stuck out, so I wanted to know a little bit more. So thank you.
this is just, I can't really elaborate
No,
why
you
this
can
happened.
elaborate on it. Thank
Yeah.
Larger buildings, more expenses.
But there's still some small buildings that are not here, which you're aware of.
Right, residential-only buildings with less than 11 units are generally not included.
That's like comparison to the stock, it's a lot smaller.
It's
percentage.
smaller,
Yeah.
but still, we hear from those people in the testimony, those kind of 6-unit, 7-unit over buildings.
That's a question related to that. So the overall sample's about 2/3 or so of all the rent stabilized housing, right? About 600 and something thousand out of roughly 900 and something thousand.
Right, well, these are buildings that contain rent-stabilized units, so
Right.
they also contain
Right.
unregulated units, so it's really tough to know exactly, how many
I guess
measuring.
what I'm not clear about is to what extent are the omitted units that are not covered by this study similar to, or if you can know, the units that are covered by the study. So about a third of the rent-stabilized housing, I get roughly a quarter to a third that are not covered by the study, right?
Yeah, if it's not included,
Yeah.
there's not really a way to measure it.
Right.
We only have what's measured in this study, so
I think his question is what tipped it in or tipped it out?
well, it does exclude the buildings that are generally residential only, fewer than 11 units, or if they didn't file registrations with DHCR, they wouldn't be included because we match it, or if they didn't do RPIEs. Yeah, how many are missing, or, well, we can estimate, but why they're missing, I don't know.
I guess
exactly.
what I'm trying to get at is, are there any sort of systemic, biases, selection bias in terms of the units that are covered in the study relative to the overall universe of rent-stabilized housing? Or is there any way of knowing that?
No.
Do we,
I'm sorry, why don't we have data for 3 and 4?
That year, there was a problem with the data, the longitudinal data, so we've always excluded it.
It's been so long, but there was some issue with the filing. I can't remember what it was, but the data they received was not,
It was never recovered.
it's not accurate, let's put it that way.
Yeah, 2000.
Or not available at the time we did this study. I can't remember which.
do we have information on building ownership? So is there, for example, a percentage I'm just making up, buildings that are in the survey or that are in the overall stock that are likely owned by the same owners or the same companies?
We don't have any owner information from this
Okay,
study.
so this is done by LLC per building or director? Okay, thanks.
We don't, we only receive the aggregate data, so we don't even know individual building data. It's not available to us from finance, so.
It's actually done on the BBL level. So they're responsible for filing an RPIE for every BBL, if they meet the other qualifications that.
Building, block, and lot, building.
Yeah, on borough, block, and lot,
Borough,
so.
borough, block.
yeah.
If there are no more questions, thank you. I'll finish up.
Great. Actually, I just wonder if anybody wants to, if anybody wants to say anything about the study. I don't know if any of the members have any comments to make, or whether they want to make points to the other members of the board.
Well, I thought, thank you for doing the study. We're always appreciative. I think last year, one of the points that was really brought up a few times was how well small buildings are doing. And so I think one of the issues we had was just having more data around that, because a lot of the testimony from owner reps were mostly small landlords, from what I can recall.
Small landlords, but not necessarily small buildings. They had all building sizes.
Right, well, we had one year where someone said they were a small landlord and it was like they owned 10,000 buildings. But small in the context of like not a mega landlord, so like 11 to 19 units, but in that context. So I just wanted to comment that for me, I thought that it was helpful to see some kind of data, even if it was small, or a sentence saying, like what sort of, how are they doing in comparison to larger landlords, because the narrative was sort of like they're really hurting. So that was helpful, and even if we could have more data, I think it would be helpful this time around too.
Brian, what in the report could we look at that speaks to that? So we see how they did in terms of rent compared to the other buildings, rent roll. What other data on the 11 to 19s can we just focus on?
It's all broken down in the appendices. We have it, in addition to the report, but you can look at pretty much every category of data is broken down by building size. Even expenses, income, rent, NOI change. So
NOI.
you can do what you want with it. If you want,
NOI
we don't have it
change.
broken down by community district, by building size, but you can, if you look at certain neighborhoods, I guess, are more likely to have smaller buildings. I don't know if that's useful.
And so Brian, where's NOI change by building size?
Appendix 12, page 29. I think it's pretty much what we have is in here, right, Brian? I mean, you just.
Yeah,
have
I
to
mean,
know
we
where-
summarized it. Yeah, the buildings, the smallest buildings, 11 to 19 units, NOI rose to 1.2%, whereas in the largest buildings, 100-plus units, it declined 2.7%.
So the implication of that is even if their rent roll increased at a faster rate, their expenses also increased at a faster rate.
Right,
So-
if you go to Appendix 11, right across from there, you'll see that all the costs for that citywide 11 to 19 units went up 4.8%, which is above the city average of 4.3. So that's why your NOI,
So they're
Is
doing well on rent,
1.2%.
they're doing poorly on costs, and then they're kind of, their NOI is roughly
But-
flat, 1.2%.
Right. and you can look at different boroughs and see where that happened even, so.
Core Manhattan was the one section of the city that saw NOI decline, really. It
Yeah.
rose in Upper Manhattan and the other boroughs.
So you can see larger increases in NOI in that smaller group, especially in pre-47.
But this is just a small point, but 11 to 19 in Upper Manhattan, they were like gangbusters, right? Their NOI increased 9% compared to way higher than anybody else.
Right.
Which pages?
So on page 29, chart 12, on the
Chart 12,
right side.
right
The
side.
right side,
Okay.
you can see that Upper Manhattan, 11 to 19 units, NOI went up 9%, which is way higher than anybody else.
Yeah.
Yeah, so really where NOI was dampened by Core Manhattan, because their rents increased and their expenses were higher.
It's because they're post-war or pre-war when they're more in distress.
I think they may be more deregulated units in these buildings in Core Manhattan, so the market rents for the deregulated units probably went down during this period. That there's no way to differentiate between the stabilized units and unregulated units, but that's perhaps.
Yeah, I mean, the majority of deregulation, I think our changes report says about what we track, about 80% of deregulation is in Manhattan. So if you want to take a look at the outer boroughs for more of a snapshot of buildings that contain stabilized units is probably the best way to look at it.
I mean, the other thing that stuck up to me around just the legal rent and the collectible rent, I think that that's something that I always look at year to year, just because you could collect the 1,800 doesn't mean you actually are able because of market. And I think that this year, again, we're seeing sort of the same trend of legal rent being a lot higher than what was actually collected. And I think that every year I'm always looking into that, just because I do think that preferential rents at 28% have traditionally been. I don't know if that's.
It's almost 30%.
Can you
again.
show
almost
that
30%
chart
now.
again of the collected versus, I was surprised how it's page 6?
Shayla, could you just explain a little bit more how you use that information? Why is that relevant to your analysis?
Yeah, I mean, I think if you think about what is collectible, and we're talking about making adjustments to the overall legal rent for rent-stabilized units, if 28% of landlords who could collect the legal rent aren't collecting it, to me that says something about the market. And so if we're increasing the legal rent and it's not being collected, then the increase is actually impacting a lot, like people, the market isn't calling for that. And so I do feel like it to me is an indicator, especially since we see it in for tenants who are actually struggling, and that increase or that bump, that instability of a legal rent is actually causes displacement and causes a stress in those buildings. That's 28% of the legal rents that are collected. And so I do feel like, to me, is a good indicator of, are we making, like, what kind of impact are we making? And then when you take out the core of Manhattan, I feel like it even paints a bigger picture, a more fully picture for us of what's happening in the outer boroughs. And then when you look at where the increases in rent are going in areas that were recently rezoned or that we've seen that are, the communities are under stress, I think that it even paints a larger picture of what's happening in the city. And then, like, what are increases as the RGB actually contribute to that instability of the housing stock.
There's another thing going. That's true with, certainly preferential rents impact that difference. But I think the other thing that does is also, if you're taking units that are deregulated and including this in here, they're vacant at three times the rate of a stabilized unit. So you're talking about the collection loss of a vacant unit.
I see. So this is just,
Versus one that's occupied for the entire year. So even if in if an apartment's vacant for a month between tenancies, that's going to be reflective in the I&E
Right.
rents, because that's rent not collected. And so, since we're seeing a deregulation units vacant at a higher rate, that accounts for some of
yeah.
that.
So is there data on the number of units that are at preferential rents versus the full allowable rent?
Yeah, about 30%.
30%
Of the units that are stabilized are getting preferential rents, less than the legal amount.
And how
allowed.
is that, and you have data on how that's changed over time?
We do, actually.
That would be
We do.
interesting.
We did a memo last year that tracked it, I think for about a 10-year
good.
period or more. I forgot what we get that information from Housing and Community Renewal, Homes and Community Renewal. And we did track that. We can circulate that memo again.
And one other thing I just noticed that I guess it's core Manhattan, the average rent stabilized rent is about 2,500 or something like that. So it's getting pretty close to the threshold for.
Well, that's, once again, this is the rents in rent-stabilized buildings, so it includes both
Oh, okay.
stabilized rents and
non-stable.
unregulated
I
rents.
see, so you don't know
Yeah.
what the actual rent stabilized rent is.
Right, it's not broken down in this.
Yeah.
Just get some data from DCR about.
They have it.
Construction and only rents, like, you could get some data.
The data that they have is rent-stabilized only, yeah.
And that includes the units that are rent stabilized under like the tax incentive programs where you don't get deregulated at the same
Right.
threshold as for.
Yeah, one of our last reports reports on the number of additions and the rents in those 421A buildings are, yeah, significantly higher.
Any other comments from the members?